it's fascinating because recently something happened which the macroeconomists believed was absolutely impossible. And that is you had a rise in the bond yields, a fall in the purchase in the dollars trade weighted, and a rise in gold.
The price of gold has gone higher from an institutional standpoint. You've got institutional buying, you've got hedge fund buying. Most importantly, you have central bank around the world buying. In the last 9 months, I've seen more selling than I've seen collectively in the last 15 years.
The situation is rather bizarre. The wholesalers are just inundated with inventory. The wholesalers are doing whatever they can to try to offload inventory. So they want to get rid of that inventory. And the retail market's dead.
Step of making an executive decision, and I lowered the premium on junk silver right now to 99 cents or $1.
In today's news recap, silver price soars to $37, outshining gold as Middle East tensions build. Silver pierced the $37 level for a fresh 13-year high on Tuesday as market sentiments shifted towards risk-off assets amid rising tensions in the Middle East. Spot silver jumped as much as 2.2% to $37.26 per ounce, its highest since early 2012. Silver futures saw a similar rise, hitting $37.33 per ounce in New York. Silver's breakout follows speculation that the U.S. is preparing for a more direct intervention in the Israel-Iran conflict, adding further uncertainty to global markets. During times of crisis, investors tend to seek safe haven in precious metals like gold and silver. However, despite this narrative, gold saw minimal movement, with spot prices hovering just below $3,390 an ounce for a 0.2% gain. This further stretches the divergence in gold and silver seen in the past week, with the gold to silver price ratio now hovering near a 3-month low. At first sight, gold's reaction may be surprising, considering the potential consequences of the conflict and also the typical skittishness of the more short-term oriented traders in the market. Karsten Menke, head of Next Generation Research at Julius Baer Group, told Bloomberg, "Gold's pause bodes well for the next leg higher," Swiss bank UBS said in the Bullion Vault report, emphasizing that gold's bullish sentiment is unchanged. Gold is on track to target April's all-time high again, MKS PAMP strategist Nikki Shields stated, because the outbreak of direct Israel-Iran conflict gives a new catalyst with nuclear risk. Now we'll show you the best clips of the latest interview. Don't forget to like, subscribe, and turn on notifications so you do not miss out our daily recaps. And check goldsilverstacks.com to get your Stacker's Handbook, the ultimate guide to stack gold and silver, packed with strategies to trade the gold-silver ratio and get more ounces and build wealth over time, so you don't have to rely on market commentators to make your investment decisions. Enjoy the episode.
Smart money, if you want to call them that. The bullion banks, the commercials, the people that really know how these markets operate because they are operators of these markets, they will get to a point where they're caught short. And it happens very rarely. What they'll do is they will step aside and they will not basically put on any contracts. I'm using a broad brush here. It's not exactly this, but it makes the thought process more clear. So they step aside and don't do any shorting. And so now the market's driven by the funds and the retail market. So now it will exhaust without them in participation of it. So now the price goes higher and higher and higher, but there is no retail buying, but there's some, but very little. But the the trading funds may be buying, but eventually it'll exhaust. So they waiting for it to exhaust, and then it'll start to come down. Now, since they can print money to infinity, once that momentum starts on the downside, they'll pound it. They'll come in and start selling like crazy, knowing that that momentum has changed in their favor, and then they'll start to really. So now what happens is the funds will have to start exiting, probably at a profit. Let's say they're long at 35 and price goes all the way to 42 and then it exhausts. Then at 42, the banks know, okay, now we've got momentum has changed. We could start shorting. So it's short at 42, it goes down to 41, short more at 41. The bank was in at 35 and now it's at 41. So let's take a profit here, which is more selling. Selling on top of selling. The banks are shorting and the funds are long and they're selling to get a profit. Those trades have to match. If somebody wants to buy it at 41, there aren't many people. In fact, there are none. No one wants to buy it at 41 on the way down. They'd love to buy it at 41 on the way up. So now what happens? The next match is $38 the ounce. I'm exaggerating for effect. So that's where you get the gap in the chart. So no one wanted to buy it at 41, but a lot of people wanted to sell it at 41, but they don't match. So now the next match is at 38. Again, I'm doing it for exaggeration, but that's why you get a gap in the chart. Happens in corn, happens in wheat, soybean oil, cotton, cocoa, doesn't matter. It happens in the commodities markets. But this is what drives me nuts as far as the futures markets, and I'm not against them. I'm just against them being used in the manners that they've been used. And it's not just in silver, although silver's the stellar example. I mean, there's more, paper shorts in silver versus the actual reality of the physical market than any other commodity by far. In fact, it's in the metals by far. But nonetheless, I'm not predicting, a big sell-off at 42. No, I'm just outlining how the futures market works and why you don't want to get too excited if you don't have that retail pressure on the market. Now, let's look at the other side of the coin. And actually, the most important side is investment demand. That's the swing factor. That's what is ebbs and flows. That's what makes a market a hot market or a bear market. It's the margins, the people that buy silver for investment. But 60% of the market is industrial, and that doesn't go away. It can ebb and flow, but mostly it's pretty steady, and the trend is clearly higher and higher.
Bubble, and if you don't believe we've got a credit bubble, just look at there's a debt bubble at the moment. Now, the debt equals credit. It's the other side of it. So if you've got a debt bubble, you've got a credit bubble. We've got a credit bubble. You've also got Smoot-Hawley Mark II, Tariff Act. These are precisely the situations that America had in 1929. This time it's worse. So the way things are going to evolve is that the dollar is going to get undermined. Financial markets are going to get undermined. And the only way, in theory anyway, to stop this or slow it down is to raise interest rates, which will kill the equity market even more, but might offer a little bit of protection to the dollar. Because if you've got higher rates, then, okay, you might sell equities, but you'll probably leave the money on deposit at a bank in dollars, sort of thing. So particularly as under those circumstances, other currencies will look even less attractive than the dollar. Look at the European situation, for example, or the Japanese situation. So, one way or the other, the Fed is going to have a really difficult choice on this one. But I think eventually, as businesses and pretty fundamental businesses start going bust, which I'm just saying what happened in 1929 to 32, whether it's businesses or banks, lenders to businesses. In those days, it was the farming industry mainly, if you like. But this, today could be anything. It could be high-tech businesses. I think that you'll find that the Fed will have to rescue quite a lot of what's going bust. Now, when it's doing that, how does it do it? One way in which it has to respond is to take the pressure off the economy by lowering interest rates. But it can't do that because it'll just kill the dollar and make the situation even worse. So, the Fed is getting into an extremely uncomfortable position. And I think this is basically, if you're a central banker, you can see this. You can see this happening. You can see the problems and also the political pressures on the Fed to reduce interest rates. The market pressures, everybody in the market, with very few exceptions, of which I'm one, believe that interest rates will go down. Central bankers see this differently. They see this as being really an extremely dangerous and difficult situation. And would they really rather want to hold all the dollars they've got? I think they would rather lighten up, and that's what they've been doing. And they've been doing it now for the last 4 years.
In today's news recap, will gold prices continue to hit all-time highs in 2025? Gold prices have rallied significantly this year, climbing as much as 30% year-to-date when they peaked at $3,500 per ounce in April, surpassing J.P. Morgan Research's previous forecasts. As markets weigh policy uncertainty and geopolitical risks, what is the outlook for gold prices in 2025 and beyond? Earlier this year, we examined the structural shift in gold's demand and geopolitically influenced pricing drivers fueling its rebasing higher, ultimately posing the question if $4,000 per ounce is in the cards, said Natasha Canova, head of global commodity strategy at J.P. Morgan. To answer the question, yes, we think it is, particularly now with recession probabilities and ongoing trade and tariff risks. We remain deeply convinced of a continued structural bull case for gold and raise our price targets accordingly, Caneva added. J.P. Morgan Research now expects prices to average $3,675 per ounce by the final quarter of 2025, rising toward $4,000 per ounce by the second quarter of 2026. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button, turn on notifications, and check our new numismatics handbook. Most stackers want to get active, but swapping their metals for dollars isn't an option. There's plenty of opportunities in the overlooked numismatics world. Mastering U.S. coins, key dates, and errors pays off by multiplying your ounces and capitalizing where others aren't paying attention.
You can't forecast a price if there's no supply. I mean, it will end in a failure to deliver. And look at the price of gold, look at the price of silver, much, much higher than they were 6 months, a year ago. And all of those shorts are underwater now. All the shorts in silver are underwater. All the shorts in gold are underwater, which means they've got to be meeting margin calls. And okay, so the money gets printed up and maybe even lent to the shorts, but it's not going to make any difference because at some point in time, the herd will move in unison and say, "I want my metal. I don't trust a paper contract." My late partner Jim Sinclair used to always say, "What's the value? What is the value of a contract that cannot perform?" And the answer is zero. And if you're zeroing out contracts, I mean, he was talking about, you could see COMEX gold, $10 offered, $10 offered, no bids. And you could see it in the cash market, $50,000 bid and no offers. And that illustrates the value of a contract that cannot perform. It's worth zero. But that's going to bleed over to the entire derivatives complex. I mean, what does that mean for oil contracts? What does that mean for rice? What does that mean for wheat, orange juice, et cetera, et cetera? It's going to push the world more or backwards toward cash and carry trade, as opposed to the financialization where paper contracts can push the price of an asset around to fit whatever the current narrative is. I'm not going to name any. I would just say that gold and silver are money. And historically, when the shit hits the fan, you want to be in cash. In the old days, 100 years ago, cash meant dollar bills or a currency that was backed by gold or exchangeable for gold. That's no longer the case. Going to gold, going to silver is going to cash. And that's what you do before recessions, before World War III, whatever. You know, if you're trying to hide, you're trying to find a safe haven, gold and silver are the ultimate because they cannot bankrupt.
I think that's a valid point. When I think of the silver that I own, I think of almost exclusively trading it to gold at some point when the ratio snaps back. Now, that may not work either, but I agree. with what he is saying. I mean, I honestly feel there's so many things pointing to a resetting of the monetary system. You can be as basic as Scott Dissent saying in an interview recently that there will be a new Bretton Woods monetary system style event within this administration. You can see the massive deliveries into COMEX and gold and silver. You can see so many things happening right now that are unusual. And then you look around in a system that is based upon trust. You see what's happening right now in Los Angeles and Atlanta and New York and Chicago and in Dallas and Austin. This is not lost on the rest of the world. It's embarrassing. We are a country that seems to, in my opinion, somewhat of lost its way, spiritually, morally, culturally. We are, I thought this stuff was behind us, but it appears it's not. And where's the trust? When you look at trust politically, economically, monetarily, and then culturally, so many of the things that as a young man or woman in this country growing up, you would aspire to be, these things are changing. Our culture is changing right in front of us. And so I think that a new monetary system is not so far-fetched anymore. We've been saying this for a while now, but what Clive says is exactly right. My guess is that we are on the cusp of a new system. What does that new system look like? Going back into dollars is the last place I think that you would want to be. So if I were drawing a playbook, I would say when the ratio gets anywhere near 45-ish to 1 silver to gold, the play is to switch to gold. Ultimately, I think that is going to be sort of the tether to a new system, will be gold, whether it be with the BRICS nations or all the countries in the global east and the global south or here in the United States. I believe that the Trump administration said to President Trump, this needs to be done right now. We need to start bringing this stuff back. We need to start reshoring. We need to do this because we are losing rapidly to the rest of the world, who is wise to the suppression of the paper markets, which have been done originally to support the illusion of the strength of the Western system, the strength of the bond market. This is a game we are being beaten at rapidly. And I would agree with him. I don't think you can look at things, if you're owning gold and silver, for the reasons that most people are these days, than to expect an orderly transition from silver or gold to another asset may not play out the same way this time. Granted, I think what it does is it gives you the ability to potentially sidestep any potential trouble in the legacy system, have dry powder, and take advantage of value and whatever that may be here in the United States. But to expect it to be linear the way that we've always expected things, I think is a stretch. So yeah, I guess we'll see. But I think people will look back at their gold and silver holdings and realize that this isn't about return on money, that this is about return of money. This is to sidestep all of the things that seem to be bearing down on this country and on this on the West all at once. I mean, even as far as the new payment system that seems to be happening with the bridge system that is connecting so much of the world, the renminbi bridge system, which is M-Bridge, they come very clear and come out and say it is not compatible with the dollar, the pound, or the euro. So they're moving in one direction. And by default, I think we will move in another direction as well. So yeah, if I had to guess, there's an equally good chance that we see a monetary system as we would seeing silver at the levels many people dream of. What does that look like? Only time will tell. It's very difficult when you're sailing in a sea of uncharted water to have an idea of where we go. But I would say it is closer to what Clive is saying than what most people would see in their mind's eye as to what the end game is.
What do you think of Morgan's take? Do you agree that the silver market is dead and this is just a silver squeeze? Is platinum still massively undervalued and buying hard assets is a smart way to protect your savings? Or do you think this big reset scenario is overblown? Post your honest opinion in the comments section down below and share your gold and silver price predictions with the Stacker community. Now check out this next video right here because it's the perfect follow-up for you. I'll see you on the other side.